Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it's my pleasure to be your host again for today's episode. In today's podcast, we'll be looking at what's happened over July 2026, and we'll discuss the outlook going forward. This podcast is being recorded on Tuesday, the 4th of August, 2026. So to start things off, joining me again today is our Chief Investment Officer, Rob Hogg. Hi Rob, welcome back again.
Hey, hi Steve, thanks. Nice to be back.
Indeed. And there's been some interesting moves, Rob. In July, we've seen global bond markets really do some very interesting moves, which I know you'll talk about. One of the things that worries me a little is that the US 30-year, for example, at 5.2% is the highest yield we've seen since, well, almost 20 years. And Australian government bond yields also rose. Is this concerning us in relation to the equity market?
Well, I think if it continues, it almost certainly will. It isn't concerning markets a hell of a lot just now. But as you say, we saw some pretty significant increases right across global bonds during the month of July. So, for example, in the US, the 30-year yield that you mentioned, I think it's the highest yield since 2007. The yield rose a little bit over 30 basis points, so 0.3 over the month. In Australia, we saw increases in yields as well. Our 10-year yield here up a little, fractionally over 20 basis points, and yield curve steepened, which means that the increases in yields were greater at the longer end of the curve, so for longer maturity bonds. But this is a very broad-based thing across pretty much every country. So Germany, for example, 10-year yields rose about 35 basis points, so 0.35. Same in France, around 25 basis points in the UK. Japan, where the numbers are smaller, as in the yield finished at around 2.8, but that was an increase of 12 basis points. And some of the peripheral European countries, so Italy, Spain, Portugal and so on, they had increases in yields of like 40 basis points or more. So an extremely consistent, extremely robust and profound increase in longer-term government bond yields.
And what was the key reason for that?
Well, the key reason was not, as you might suspect, inflation-related or oil-related or anything like that. In actual fact, what we're witnessing across the globe is an increase in what are called real yields. Now in the US, they're called Treasury Inflation Protected Securities, or TIPS. They've got a slightly different name here in Australia. They're called Treasury Indexed Bonds. But anyway, these are quite particular bonds issued by governments where the coupon payment, so the half-yearly or annual coupon payment, is often indexed to the CPI. So the coupon goes up in line with inflation, and then most usually the final principal payment is similarly indexed to CPI. So these types of securities give an investor a return, a coupon payment that moves ahead, moves up and down with the CPI. And this is what is driving bond yields. It's the increase in the TIPS yields. It's not an increase in expected inflation, which is the other component.
So the only way to really read that then is, okay, if it's not an expectation that inflation's increasing as such, it's an increase in the risk premium required, is that right?
Yeah, that's exactly right. The term premium is how bond investors might describe it, but yes, it's the risk premium. And it's not always altogether 100% clear. I mean, you can't just back out, why are real yields going up? But they're most often a measure of supply-demand dynamics. So in that context, higher and higher, using that definition, working definition, higher and higher yields on real bonds suggest, in a sense, market indigestion with the supply of bonds. And that's most likely occurring because we see bigger and bigger budget deficits, bigger and bigger fiscal spending. That's not just in the US, this is a global phenomena. And of course, we're seeing a huge increase in private sector investment as well. So if you want to think about it as the overall supply demand for investment. relative to saving, and that's what I think is being is what is occurring, and it's extremely powerful. And these real yields in the US, I mean, we've spoken about the nominal 30-year yield, highest since 2007, but these real yields, in some cases, are pretty much the highest they've ever been. Wow.
So, I mean, you're saying that the equity markets are pretty sanguine at the moment. What happened over the month in the Aussie market, the US market, and so on?
Well, sanguine at the headline level, but like the duck swimming across the pond, there was a hell of a lot going on underneath. So July saw a huge rotation out of semiconductor-related stocks. So the Philadelphia Semiconductor Index, or SOX, SOX, that was down around fractionally over 20% for the month, as was the Korean Kospi. Now, both these indices are very heavily weighted towards these semiconductor stocks. So in the US, for example, we're talking about companies like Applied Materials, Advanced Micro Devices, Broadcom, NVIDIA, Qualcomm, Intel. These are big names, Taiwan Semiconductor, Texas Instruments. These are the types of stocks that we see represented in the semiconductor index in the US. And similarly in Korea, we're seeing some big names and some huge volatility. Now, both of these indices, both the SOX and the Kospi, they'd already risen, I think, around 100%. So they doubled to the end of June, and they've given up, well, just 20% in July. But just symptomatic of the fact that there's huge volatility going on underneath the surface. But broadly speaking, US markets were sort of flat to slightly down. I think the S&P fell just 0.1. NASDAQ a little bit softer than that. Here in Australia, we actually eked out a gain. Not often, the Aussie market outperforms at the moment, but we did. Although our small cap index fell over the course of the month. We've seen volatility as well in Japan. The Japanese market gave up some of its recent gains in July as well. But again, we'd seen a period where the Nikkei and the topics had performed incredibly strongly up until the end of June. So giving back some of that, and that's sort of semiconductor related as well.
So, I mean, clearly the war has not finished. The market got a little bit comfortable, and then towards the end of the month it got less comfortable, but that didn't really seem to drive the markets this time, did it?
No, it didn't. Oil went up by fractionally over 20% for the month, but I mean, we're living in a world where 20% a month is almost neither here nor there. Right. And I mean, of course, apart from the direct impact on energy-related stocks, and the oil price most directly up 22%, but we didn't see really any increase in inflation expectations off the back of that. Again, it's in the bond market, it's all about real yields, and we didn't really see much of an increase in expectations for monetary policy tightening either. Whereas if we wind the clock back just to March, as the war started and the oil price took off, we saw a much bigger reaction in the shorter end of global yield curves. We didn't really see that this time. I think that speaks to the volatility and the fact that it's very, very difficult for investors to make a judgment about exactly how the war is going to pan out.
And at the same time, and maybe this is a good point to drill down to some of the things that happen. Trump has reinstituted some tariffs. Can you talk about that?
Yeah, so I'm sure we all remember that beautifully named Liberation Day, April 2 last year, when Trump just unilaterally imposed all of these tariffs under an emergency powers facility that the president has. Well, that's been overturned by the highest court in the US. So they've now changed tack, and they're now using a different approach, using these so-called Section 301 measures. But look, bottom line from all of this is that switching to this different type of tariff which is much more individualistic. So you tend to impose these 301 tariffs on individual countries, not groups of countries, and they're using the clause in regard to slave labour in this particular case. And individual countries will have individual judgments against them. In Australia's case, we saw a very, very, very slight change in the effective tariff rate, but not only a percentage point or so. And that's the same really across the globe. So this really came and went without really any market reaction at all.
Okay, so almost nothing to see there.
Almost nothing to see there, exactly.
So what about there was a few comments, and you made a comment in your monthly about the new Fed style, Mr. Walsh. Can you talk about that? He was initially hawkish, as in more aggressive in terms of positioning for rate hikes. Is that no longer the case? Or
yeah, let's talk about this guy. So he was a member of the Fed, I think 15 or 20 years ago, and I've got to tell you, he used to write some really, really great stuff. He used to make some incredibly good speeches, and was a leading thought, a leading thinker of the Federal Reserve. That's not to say he's not now, but he's got a long history. Anyway, the nature with which he was appointed as a very clear favourite of President Trump sort of led the market to think, well, look, maybe he's going to be, as we describe on the beautifully named Avery scale, he was expected to be more on the dovish end, so less likely to raise rates or more likely to cut rates. Anyway, when he first came in as chair of the Federal Reserve, some of his very first comments were a little more hawkish than the market had expected. So the market was expecting dovish. They got somewhat hawkish. So the market gave him a bit of a tick. That was back in June. But then July, we have this Federal Open Market Committee meeting, the policy meeting. And whilst he spoke about, the fact that they're focused on inflation, they didn't raise rates. So that sort of gave bond investors a little bit of a concern. But what's really freaking them out is the lack of forward guidance. So Wash has made a really big thing about no longer providing so-called forward guidance. So forward guidance is where you give the market a bit of a sense about where you think the next policy move might be. And one of the reasons for doing that is that you can guide the market to do what you would otherwise have to do via policy without actually having to do it. Yeah. Now, he sort of argues, yes, yields have gone up since he became chair, they have, but I don't think that's because of anything he's said. I think it's because of everything he hasn't said. So the market's really flapping about, trying to understand, is he a hawk, is he a dove? Is he focused on inflation or not? We really don't know, because he's said some stuff but hasn't really done anything. He's determined not, for example, to include his own dot plots. This is this practice that Fed members have where they put literally dots on a chart about where they think rates should be if the economy is performing as they expect. And that's a really quite a clear sort of form of forward guidance, but he won't participate in that. So I think what we're seeing is uncertainty amongst bond investors, and uncertainty almost always leads to a lower price than you might otherwise have seen. And in bond land, that means a higher yield. So that's all part of this, part of what's going on as well. But interestingly enough, not really reflected in an increased break-even or inflation expectation. It's sort of cobbled together with all of the stuff that's driving up real yields, interestingly enough.
Okay, so it's certainly, as you say in your monthly, that it's increasing market uneasiness. Not only with the increased supply of government bonds, as you mentioned, but also the lack of clarity. What's your sense about why he's doing that? I mean, what's the cunning plan?
I don't know. Right. I don't know what the cunning plan is, because he's certainly not stupid. Maybe he's super smart, and maybe it'll all turn out okay. So and look, to be fair, if we look at what's happening with the economy, which is obviously what's going to drive what he does anyway, and he's only one vote, of course, and that's interesting to note that 3 members of the committee voted to raise rates, not leave them unchanged, but because they didn't hold the majority, nothing happened. But the underlying trends in the US actually look pretty okay. Inflation, look, it's still a bit sticky, but it doesn't really seem to be accelerating. And the underlying economy is actually doing really quite well. Employment is doing okay. Manufacturing and the services sector, they seem, if anything, to be picking up momentum. So that's really a pretty good sort of background and environment for an economy and for a central bank to be presiding over. So with that sort of environment, slightly accelerating growth, sticky but easing inflation, there's no real big call to actually be raising rates.
Right.
Necessarily in that sort of context.
So maybe he's just jawboning, or not jawboning. I mean,
well, perhaps he'll prove to be far more accurate in his forecasts of what actually happens with short-term rates.
The other thing, talking about rates and so on, the level of raisings by the corporates, particularly in the US, has been at record levels, and I think year to date we've seen probably the highest amount of bonds issued across the corporate bond market for many years, and we're not even at the end of the year, right?
No, that's right.
As you said in your report, tech is a huge amount of that, and the credit default swaps have certainly reflected increased risk in that area, haven't they? Have you got any concerns about corporate bond issuance?
Well, look, this is all part of the whole sort of real yield story, because the demand and supply of funding is not just a government thing, it's a government plus private sector. And as you just said, corporates are really increasing their borrowings in the United States in particular. And a lot of this now, about a quarter of these issues have been from the tech sector to fund CapEx. So a lot of this AI related. So that's sort of adding to the pressure on overall bond yields across the globe. This increased demand for bond or bond related borrowings. So tech's really been driving this, and interestingly, we've started to see, so after these bonds are issued, you can then look into the aftermarket, as it were, and it's just the same with any equity, like SpaceX, that a lot of people have been naturally enough focused on. You look at the price in the aftermarket, so the price in the aftermarket for these tech-related bond issues has generally drifted lower, which is to say yields have drifted higher. So we're starting to see, particularly for tech-related issuance in the corporate bond market, that the aftermarket is judging these issues harshly. We're also seeing, for that matter, that buyer demand for new issues, and we measure this by a thing called bid cover, which is just the total value of investor bids for a particular issue, the total value of bids relative to the total value of bonds being offered. We're starting to see those sorts of metrics deteriorate as well. So they're just another sign, I think, of this indigestion, in this case in corporate bonds, but we're seeing the same in govie bonds as well. And this is what's driving the total yield structure higher, and in particular being driven by this higher and higher real yield component. It's supply and demand for funds.
Interesting. But on the other hand, you're saying, so there's a lot of money being raised out of the corporate bond market, and on the other side, you've mentioned the global growth prospects are improving. So, I mean, if we can get a resolution of the conflict in the Middle East, you've said this before, we could end up with almost a Goldilocks environment.
Yeah, absolutely.
How are you seeing the key indicators of global growth?
Well, we look at some of these sort of leading indicators, and look, a lot of them are this so-called soft data, and we know from the last couple of years, and we've written about this, that this soft data can really send you in the wrong direction. So back in March, the surveys and sentiment and everything all fell very sharply, understandably, as the war broke out. But the underlying economies globally just didn't really tend to follow that. So why then are we looking to these surveys as an indication of perhaps that things are picking up? But they're just part of the whole story, really, that with employment remaining, I mean, it's not growing as quickly in the US as it has been, but it's still rising. Unemployment claims are low. Things like new orders are picking up. The background looks pretty positive, and of course the US has had tax cuts, the great big beautiful bill. Of course in Europe we've got what the Germans are doing fiscally with spending on infrastructure and defence. That's pretty powerfully positive, and we see that come through in surveys of corporates in Germany as well. And of course in Japan, as we've spoken about before, the Japanese Prime Minister is definitely of a view to increase fiscal spending. So all of this sort of suggests, yes, it is, if not for the Middle East war, we'd probably be looking at a really, really strong year of global growth.
And potentially higher interest rates on that basis?
Well, yeah, although higher interest rates for the best of reasons, and by that
Yeah.
I mean specifically because growth
is
was just
going,
accelerating and growing at a rate beyond, a sustainable long term. But that's the best reason for rates to go up,
absolutely.
and
Yeah.
equities can do relatively well, indeed quite well. Equities don't do well when rates have got to go up because of inflation, and that's sort of what we were facing in April, May.
Okay, so let's move to Australia then. There's one country in the world that is raising rates, and although we didn't raise last month, it's interesting what the governor has been speaking about in terms of inflation, in terms of the cash rate, but also in terms of housing. Talk us through what the Reserve Bank's currently thinking.
Yeah, so we had a speech from the governor, Michelle Bullock, right at the very, very end of the month. And look, I reckon she's got a really, really tough gig for a whole lot of reasons. Not the least of which is that she now chairs a pretty much fully independent monetary policy committee. So independents have a majority vote on this committee. So she doesn't really know what they are going to do and how they're going to vote from meeting to meeting. So that makes it, that's different to how it used to be, where there was not a majority of independents, and the RBA governor of the time had a pretty good idea how meetings were going to transpire and what decision was going to be made. So that puts her in a tricky position. She cannot really use forward guidance because she doesn't really know exactly how people are going to vote. So I reckon that makes it tough just to start with. The other, she's of course sort of swimming against the tide of continued government spending, and that makes it trickier and trickier for her and the RBA more generally to try and ease inflationary pressures. So that's tough as well. And we've all heard a lot about this productivity story, and it is abundantly clear, sadly, that the Australian economy's long-term trend rate of growth is now closer to 2%, whereas it used to be 3 or 3.5 or thereabouts. Anyway, all of this put together is sort of a way of trying to explain, as she reiterated yet again, that Australia's inflation pressures predate the Middle East war. So the economy was, at the start of the year, growing at a pace that was tending to drive inflation higher. The RBA raised rates in Feb, so this is before the Middle East war broke out. And of course, they've had to raise rates twice since then. So Australia's in a sadly unique position of having to raise rates before any potential inflation impulse from the Middle East. So, and that's all about this capacity related stuff. So anyway, she's still saying, as I think she probably has to, that The board, the Monetary Policy Board of the RBA, is prepared to act as required to achieve its mandate, so that's its inflation mandate, including by increasing the cash rate further if needed. So she said that, but she's sort of been saying that for a while. What she went on to say in the same speech was that the housing sector has been weaker than the RBA had expected, and that's really what got the market to run. So when the market hears that the RBA is pointing to something that's weaker than they had expected, well, you start to see slight changes at the very short end of the yield curve, which is sensitive to what the RBA does. So we saw yields on 2 and 3 year securities fall by, I think around 5 basis points on the day. And then they fell the next day, yields, as the CPI came out for June, and that was fractionally lower than had been expected by the RBA, by the market. So we've seen at the very end of the month a not insignificant step down in rate hike expectations, because we entered the month with the market still thinking the next move is up. The market still does, but the market has now pushed that expected rate hike from August further out to the end of the year. But even by the end of the year, there's not a full rate hike price. There's only about a third, between a third and a half of a rate hike priced.
In other words, what you're saying is that it is possible that we've seen the end of the rate hike cycle.
Oh, absolutely. And the clearest reason for that is probably in the housing sector, where, as everyone sees almost every day, news and reports and feedback about everything from auction clearance rates to actual house price indices, all of which have been falling quite sharply. Now, I know that not every state capital has auctions as a significant form of sales, but even in capital cities where auctions aren't terribly significant, we're starting to see house price falls as measured by some of these house price indices. So house prices are falling, auction clearance rates are falling, probably as a consequence rather than the other way around. But why is this all important? Because there are big multiplier effects from the housing sector. So with falling house prices, falling auctions and just falling supply of sales on the market, you just see lower transactions, lower loan demand, etc., etc., etc. So you see less demand for furniture and fittings, less demand for a lot of other housing related stuff, and that tends to have an even broader based effect on the economy. So this seems to be a clear source of marked slowdown in the Aussie economy. What is, however, still holding inflation up is this services sector component. So we've spoken about this before. The services sector is everything from haircuts to car repair to vets. And if you can think of anything that is a service that can only really be offered and consumed in Australia, these are the types of things that are growing at where prices are growing at around 4%. And that's just really too high to be consistent with the RBA's 2 to 3% inflation target. So that is what's continuing to underpin, continuing to drive inflation. That's what is continuing to keep
And the recent
RBA
inflation number wasn't that bad, was it? So
well, it was better than feared,
yeah,
if we can put it that way.
Right.
But it's still outside.
Yeah,
it's still outside the band.
Okay.
Any which way you cut it, on an underlying, on a headline, on a quarterly moving basis, any which way. It does bounce around a bit, obviously, with oil and petrol. So June, which is the most recent number, benefited, i.e. was biased downward by falling petrol prices, but we'll see a lot of that bounce back. When we get the numbers for July and then into August, as oil prices have gone up again and the cut in tax by the federal government washes out as well. So that's the problem. Services price inflation is the issue, but the possibility is rising by the day that the weakening housing market will be enough to slow the economy more swiftly than the RBA expected, and that is what could move them toward potential rate cut. But none of the above, the housing sector necessarily is really going to drive down this services inflation in the shorter term, certainly.
Well, and in that context, it's going to be a very interesting reporting season. We've got the start of the reporting season right now, so any expectations?
Well, expectations or dispersion, earnings expectations are more dispersed than they've been for quite some time. What does that mean? That means that equity analysts are more divided in their outlooks than they've been for a number of years. And that makes complete sense because nobody's quite sure what the impact of the recent government tax changes, negative gearing, capital gains, and so on. Even though they've not been implemented yet, they will start to have an impact. So perhaps that will come through in reporting season, a bit of a sense. We've had higher energy costs. We've had higher wages growth. So these are the sorts of things that the market will be looking at. What is the impact on margins from higher costs, wages, energy? What's the impact, in the retail sector from the rate increases? What's the impact on the banks? What are they saying about loan growth? These will be some of probably the more pervasive and powerful themes that the market will be looking to get a better understanding of during the course of this reporting season.
And look, the tax changes are they are worthy of their own podcast, but the one thing that worries me is the lack of apparent thought that's gone into working out what some of the implications of these changes are is becoming very evident. And there's absolutely no doubt that whatever happens, the market has had its confidence in the ability of governments to have consistent taxation regimes shaken. And that from a confidence perspective, that's not a good thing. So even whatever happens to negative gearing, whatever happens to capital gains tax, whatever form it ends up being, there's no doubt that the people of Australia have had their confidence shaken by this.
Yeah, well, that's absolutely right, and this is because people try and make these decisions with a medium to longer term sort of perspective. So people have perhaps invested in property with a view to, and with an expectation that the tax treatment will continue the way it's been for quite some years. So once you start moving these metrics around, the goalposts, the metrics, that does then impact people's planning ability. So, and I don't really think we've really seen much of the impact yet. These things tend to be a slow burn, but they will be pervasive. The fact that you're taxing investment at a higher level, that will have an impact on how people invest, the balance between capital growth and income, and the changing tax treatment, that will, over the longer term, medium term even, have an impact on how people invest. Yeah. And it's not just a domestic thing, of course, it's a bit of a global thing as well. And we're sort of moving to a more heavily taxed structure than a number of other countries, including countries like New Zealand, that I mentioned because they're obviously very close and very similar in many other ways to Australia.
And look, I was speaking to someone who's a serial tech entrepreneur on the weekend, and they were saying that, why would they build something of huge value in Australia anymore if they have to lose 50%? The idea of the old capital gains tax regime was they built something of enormous value. It then turned into a capital gain, and the Australian economy was better off. But from a taxation point of view, they're probably better off establishing their new operation, which he's talking about, in Singapore rather than Australia. So it's not necessarily going to be good for the productivity question in Australia either.
No, it's not. I mean, they probably would have gone to Singapore anyway, even without these changes.
Well, that's right.
Because I think it would have been, I suspect, absolutely better anyway. But the way we're moving is in a direction to make it less and less likely that Australia is going to be more attractive than places like Singapore in this particular context.
Okay, Rob, well, we're almost out of time, but just let's turn to the outlook. So one of the things you have mentioned is, let's go through it. The global economy is okay, certainly less impacted by the Middle East than we thought. The market outlook, I guess going back one step, the thing that worries us both is the rise in interest rates. That's a negative, but...
Yep, that is not so much even a slow burn, it's becoming a rapidly faster burn. If yields continue going up and up and up, at some point, equities will really, really take notice.
Yeah.
So that's key, that's global. Global growth seems to be, if anything, improving, even in the midst of all of this uncertainty, which sort of suggests, imagine how well it could be doing if we had some resolution in the Middle East. But we've obviously got no idea when that might be. Australia is much more problematic, unfortunately, because of its inflation background and issues with, potential growth and homegrown inflation pressures. So that's the services stuff, services-related price pressures. Housing is clearly slowing. So the outlook here, short to medium term, looks like more slowing in the economy, but very sticky interest rates and an inability for the RBA to cut rates. And we know that's just incredibly close, the relationship between how the equity market performs and the stance of policy by the RBA. So, as you pointed out before, when sentiment about the outlook for rates changed in October last year, that is when we can really date the Aussie equity market is really failing to move any higher in a price sense. I mean, dividends have continued to be paid, but the Aussie market has been one of the weakest, still positive, but weakest performers globally. And we think it's because of the policy stance. And until the market and investors become more convinced that the next move in rates is down here, it's just difficult to be excited about Australian equity market.
And we've got one eye on, well, we've definitely got many eyes on what happens in the interest rate cycle, because obviously that will certainly be influential on what we think about the Australian market. Great, Rob. Thank you so much for your time. That brings us to the end of today's podcast. We looked at what happened in July, and we looked at what it means for investors going forward. Again, unpredictability, volatility, the rise in bond rates, these are all things we need to look at. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. And please do let us know if you have any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not